Hello, and welcome to our webinar, Connecting Strategy, Risks, and Incentives. I am Guilherme Barbassa, CEO of Actio, and Actio is sponsoring this event. For those who don't know Actio yet, Actio is a software platform that provides solutions for corporate management processes like strategy management, performance management, risk, incentives, and people performance, right? Among other solutions. So if you're curious about about Actio or strategy management or risk management in general, just get in contact with us. It's going to be a pleasure to talk to you individually. Um, okay, so this is, we have a series of webinars going on throughout this year. This is our second webinar this year. And hopefully we're going to have a series of usually monthly webinars. Keep an eye open for next events, right? And I'd like to also talk to you about our community. So our relationship goes beyond the webinar. The talk usually continues after the webinar in our community. We have in this particular webinar two distinct groups, professionals from strategy and performance management and professionals from risk management expertise. So we have communities that go deep into each of these two topics. Feel free to join them, both of them, if you wish, if you're curious about these fields. And we usually share material there, put the recording of this webinar out there as well if you want to share with other people or watch it again. So please join the communities. It's very rich environment there. About this webinar, we're going to talk about strategy, risk, and compensation or incentives. So we're going to have two experts in the field. And after the talks, we are reserving some time for questions and answers. So feel free to put your questions in the chat. Okay, we're going to be monitoring the chat. If it's possible to answer some of your questions throughout the webinar, we're going to do that. If not, we are reserving some time in the end to answer some of your questions. Okay. And for those that are interested, we will be sending out certificate of attendance. So if you're interested in getting a certificate of attendance, you can fill in the form that's going to be available in the chat by the end of the webinar. So as soon as you do that, I think within the day or maybe tomorrow at most, we're going to be sending out the certificates of attendance. Well, I'd like to welcome then the two experts with whom we're going to talk today. First, John McLaughlin. Hi, John. You're there?
Yeah, Meg, good to see you again.
Same here. John is a very experienced risk manager with well over 30 years of risk management, governance, and control, and also the founder of Audit Exchange and ERM Exchange. So welcome, John, and thank you again for participating.
It's great being here.
And also with us, we have Paulo Rabelo. Paulo is a strategy and performance consultant, helping leadership teams turn strategic ambition into sustained results. He's a former global director of performance and methods at Hunter Douglas, with global responsibility on strategy, deployment, performance management, and executive problem solving across regions, and now advises senior leaders on aligning strategy, risk, and incentives into complex international organizations. Hi, Paulo, sorry.
Guilherme, thanks for the opportunity. Very excited for this chat today.
Yeah, so am I. Thank you for opening time in your schedule to share
Pleasure.
with us your experience. Well, let's begin. Before we dive into the topics, I would like to hear a little bit about our audience, right? So I'd like to share with you a little survey just to take the temperature of where we are at with you guys. A survey is going to show up, it's going to pop up on your screen, asking you if your company has incentive programs linked to results, linked to performance. So as soon as it pops up, you can answer, and we're going to see this answer online here. So does your company have incentive programs linked to results? Okay, and we're starting to see answers come in. Half does have, more than half now, does have compensation programs linked to results, to performance. Some partially in some areas, and a couple do not have incentive programs or bonus programs in their organizations. So I actually thought we'd have more people with incentive programs or full-fledged incentive programs. Apparently, we still have quite some companies or organizations that do not have that. Well, this is interesting. It's not exactly what I expected. I thought almost everybody would have. Maybe it's the environment of large size companies that I usually deal with. Is that aligned with your expectations, John and Paulo?
Yeah, I would have thought the same as what you're saying, Guilherme. I would have thought it would be more skewed to those that have incentive programs, variable incentive programs.
Okay.
Actually, I do think there's a decent portrayal of what I see on the field. About 50% of the companies will have fully linked to results. It's some kind of performance measurement system, but indeed, a lot of them have a limited program or still haven't made a lot of progress in that area. So I do think it's a good view of the environment as a whole.
Okay. All right. Let's dive in then. This is a topic that I think it's very interesting because time and again we see this going awry, this turning tragic, right? And incentive programs not linked to risk, and very aggressive incentive programs cause distortion in people's behavior, right? And can lead to exposure to lots of risk, and once in a while we see companies actually going down because of that, right? So I'm going to start from the beginning on strategy execution and performance management and the linkage to compensation, right? So Paulo, I'm going to start with you. How are organizations using variable compensation today to steer strategy execution? What usually works well? What are the best practices on that?
Right. Yeah, that's a great question, Guilherme. I think we could do a whole webinar or a whole series of webinars just to dive deep into the details of this, of course. But what we hear is a lot of debate about the specific frameworks that are employed, whether the company is going for OKRs or MBOs or other. There's multiple names for even for the same things. But honestly, in all my years doing this, I rarely seen a company who implemented this framework by the book perfectly, right? So I think it's always a combination of different methodologies, different tools that are applied, and that really is important that the company takes into account what is the company's maturity, how is the team prepared to receive and prepared to run a system like this. Obviously, data accessibility that's going to allow you to calibrate the how deep you go into the data, the KPIs and the performance metrics that you establish. And obviously, what's the current moment? What's the strategy? What's the competitive environment? And I think all of these things define what the best system is for the company. I don't believe that there is one single system that fits all different companies, even though there are some best practices. So, but regardless of the framework, I do see three main, I would say, universal hallmarks of what a good system looks like. I'd say that the first one is the performance system delivers strategic alignment. I think in these companies, we see that variable compensation doesn't just run on autopilot, right? With the generic financial metrics that serves the entire company from the CEO to the bottom. These metrics are established and it clearly mirrors what the company's strategic priorities are, right? For the business for that specific year. So this is one thing that I see across the board from all companies that are doing a good job in setting up a performance system. The second one I would say is clarity and line of sight. I think this is sometimes companies start very ambitious with very complex programs, trying to achieve maturity on the first year. What we see is that the employee needs a PhD to calculate what their potential bonus is. And obviously, this is a sign that the system is failing, right? Because a good system should be simple enough that people would understand exactly how their daily contribution, their daily work and behaviors drive impact both in their rewards and in the company strategy. So that's the second key point that I see. And to wrap up this long answer, I think maybe the most important, the most critical, specific for this topic also is that there should be transparency and achievability in those targets, not only on the target values, but also on the target system and how they are set, right? How you set the target is obviously just important as a compensation model itself. I worked with a client a few years ago. I interviewed people across 5 different levels, and nobody knew how their budget targets came from. In that way, people just put aside as they're either unachievable, they're top down, they're black box targets, and that just drives bad behavior in my experience, right? In a good system, targets are built on a clear gap. It's supported by strong plans, and it has to be communicated transparently. So when we see people can draw a realistic path towards that, the achievement of those targets, then the variable compensation truly delivers on its purpose, right? And accelerate the execution of the strategy.
I've seen a few times incentive programs become disconnected from strategy or from performance, and they start becoming expected remuneration, expected compensation, and not a conditional compensation. Like if these challenging targets are met, you're gonna get an extra, right? And people start counting on the year-end bonus, and once that starts happening, it disconnects with the purpose of having the bonus itself, right? That is to have the extra drive and alignment on strategy, on global goals, right? Why do you think that happened in these companies? Why do you think this disconnect? I mean, I don't think it happens from one day to the other, right? It
Right.
starts
It's a
drifting
cultural
apart.
phenomenon for sure. It's part of the culture of the company, right? It's how HR and hiring managers sell compensation to the employees they're hiring. It's also how they set the system. So it's a series of different behaviors that guide into that. I had a client maybe a couple of years ago, and they had an achievement of 99% of their targets for the last 5 years. That meant the expected behavior from the team is obviously exactly how you describe, right? If you have 99%, you're already counting on that bonus. You're making plans and you expect. And I think that's a symptom of two things. I think first, you're not setting the targets with the proper stretch, right? You're not really using the system to drive strategy. You're not being ambitious enough. And second is also how you set up compensation expectations on the team. And definitely that does, you miss out on the most important part of why we have this kind of programs in place, right? You're adding a lot of complexity, a lot of confusion in these things, and you're not taking the main benefit from it. So I think those are the two main points to be tackled. It's about how you structure, communicate, and how you set achievable but challenging targets for the team.
Okay. I still have a follow-up question. I'm afraid of dragging it too long, but you mentioned HR involvement, right, in establishing these programs. You think that's part of the problem that can lead to drifting apart? Like there is a strategy and performance management area that looks at strategy, and there's HR that looks at people and compensation. When HR is responsible to defining the targets that will generate the compensation, that could be one of the reasons of this disconnect.
Very interesting point. I think I don't like to generalize. I think I've seen HR teams who are extremely strategic that sit on the table and drive strategy, and I've seen HR teams that are very operational, just running payroll and making sure the quarterly surveys are filled and then the results displayed. I've seen obviously very different types of HR, but I do think when you're separating strategy deployment or a variable compensation model that has the goal of driving strategy execution, that those two pieces cannot be disconnected. And I see when I get a client and I'm working with them, that's the first question I ask them. What is the main goal that you want to achieve from this? Are you trying to motivate the team? You want to get better performance from the team? Do you want to drive strategy? Do you have a clear strategy to deploy? A combination of both, what is it? And I think that is how the system should be set up. I think if you want to have a variable compensation bonus, there's good alternatives. I think that can be based on behaviors, not necessarily strategic targets, and you can still have a performance bonus paid out of behaviors, paid out of specific living the values of the organization, and that I think is a better system for an HR-driven program. But if the main goal is to drive performance through strategy execution, that is definitely doomed to fail, because then there is too many conflicting objectives in the way. It adds complexity, and then you end up with a mess that we described, right? All of those things tend to come on the way of setting the right targets, having the right stretch on those targets, and so on. And I think so setting up the system under the people who have the right authority to influence those topics is, for me, key for success. Absolutely. So it's a great point.
Can I just add a point there too? So I just been working with a company for the past 6, 7 years or so, and then came back to the company to help them with their ERM program. And it's a very successful company. It's based in Pennsylvania. It's been around for 60 years, privately held. And it's one of those companies where what Paulo said, like they've been meeting their bonus targets for years, 99% of the time. but they have an aging workforce. And the problem that they're encountering right now is that the aging workforce, they're moving on and they're trying to recruit, call it younger people, younger blood. And the younger blood, the prospective employees are saying, now I want to know exactly what the metrics are before I accept this job, whether I'm going to achieve this bonus. Like, I understand your past practice, but I need something tangible. I need to see the formula in order to be able to be bought into this company. And it's scaring prospects away, prospective employees away, because it's just not the way they've operated. So there's a change. Something has to change now in this company because they're going to need new employees into this workforce.
Yeah, and the MBO process is ideal for this situation because then you have a like target card, that you're going to deliver. This is what we expect from you, and the values, right? So I think that would fit well there. We have a question. I'd like to ask this question now because it pertains to this topic, and before we move on and involve risk into it. From Johnny Gasser. Hope I'm pronouncing it right. I see companies reducing the bonus plan while dealing with margin reduction. My instinct would be the reversed. Bonuses should be incentives. If you need more money, you should increase incentive. Who is right? Paulo, what do you think? In a situation where a company has reducing margins, should it double the bet and increase potential bonuses? I understand reducing margin like in a crisis of some sort, right?
Mm-hmm.
Or should it reduce, bonus, be less aggressive? Or depends, What do you think?
Again, another great question. I don't have the answer, but how I would analyze this is, what is the strategy? What are the strategic objectives of that organization for the year? Is it to keep reducing the margin, or do you want to do a reversal of that process and start increasing margins? Because if you do have a strategy that predicts an increase in margin, that opens up your space for payouts, for higher payouts and incentives. I'll talk about the last company I worked with. We had a couple flat years in growth in terms of EBITDA, and they said this year we're going to hit 900 for the first time. We're going to get 900 million, and that's all we're going to talk about. They came with an additional rule for their program to go, if we hit 900, everyone gets 150% of their bonuses. And it pays for itself, right? It's a huge increase. It's a big stretch. Really motivated the team. They did a good job at cascading, translating what the EBITDA means for each part of the company. And I haven't seen the final numbers, but they were really close to it. So I think if you have the right strategy in place, that strategy should open additional space for higher incentive payouts. That could definitely be a solution, and the higher incentives could become a way to which the company achieves that objective. But if the objective of the company is to stay, accept a lower contribution margin, then indeed that becomes a bigger problem, right? And incentives is not the only problem that they will have.
I guess it goes down to if you have a vision of an exit, right? If in the long term you see, no, there's a strategy we can adopt that would reverse this situation, then you could be more aggressive. But there are markets that are ceasing to exist, actually. So if you're one of these markets and you do not see the perspective of jumping into another market, it's kind of a graceful way out, right? Let's reduce costs, let's not spend so much money, and live here as long as it's possible, right? jumping
Or
into,
you're
go
weathering
ahead.
the tariffs, or you're a company that's approaching this and saying, we're in a storm, it's this tariff storm. And once this tariff situation resolves itself, and who knows what's going to happen with the Supreme Court ruling that just occurred, because things may have just gotten more complicated. But the view might be this will subside, these tariffs, and we will emerge after that in great shape. And so therefore, we're not changing the bonus program. These are things that are outside of our control to a large extent. And so we just need everyone to just stay put. We are going to reduce our bonus pool for the time being. Stay with us. So I think it is somewhat dependent upon the situation, the strategy, as Paulo had just said, the circumstances.
Absolutely.
All right. When we put compensation or incentive, or when the type of incentive is compensation, we put money after these results, we're actually putting a lot of pressure for the result, right? And pressure, if not well applied, can cause a bunch of distortions, right? So, Paulo, what risks emerge when variable compensation is strongly tied to strategic targets, but disconnected from risk considerations?
Yeah. First, I like to point out that the way I see not tying compensation to strategic targets is a risk in itself. Obviously, I think you lose a massive opportunity to drive performance and that's a risk in itself. But when you tie compensation, especially when you tie it heavily to incentives without having any risk guardrails, the biggest danger is that you inevitably end up driving bad behavior from the team. I think you're essentially incentivizing the team to, like I like to say, they're selling the future to deliver the present. That's can be the kind of incentive that you're creating for the team, and that actually in the ground that looks like a series of different bad behaviors. So people take operational shortcuts. I don't know. You can see a manager cutting maintenance investments, cutting training, cutting R&D. I've seen this in multiple organizations to achieve a EBITDA target, right? Is the easy way out, especially when the stretch is too hard and the targets are not clearly cascaded and communicated, right? And of course, there's unethical commercial practices. You have teams overselling, overstocking their customers without clear connection with sellout. And I think those are all bad behaviors that we see. But there's also, I'll see some collateral damage that happens when you do not take into account risk. I think the first one is reputation. I think when you optimize short-term gains at the expense of risk, the customer usually pays the price. That's translated into worse quality, that's translated into worse products. And once that trust is broken in the market, I think it's very hard to reverse, right? So it is a big risk in terms of the reputation of the organization. Second, obviously, team morale is very serious. Good employees get incredibly frustrated by seeing bad actors getting rewarded while they're struggling, and they see people cutting corners, then that creates a very toxic environment for good employees. And then they feel penalized and inevitably end up leaving the organization, right? And the third, of course, is engagement. I think over time, people just stop caring about what the actual mission is, what the long-term success looks like. The entire focus just shifts into their own payout metrics, and they stop building the company and start focusing on their individual contribution and their individual bonus. So I think every good strategy needs to include, we're talking about compensation models, but every good strategy should have a component that simply says you have to do all of these things, achieve all of those targets, doing the right thing, right? And what does that mean? I think it depends on the strategy and the organization. But if your incentives don't reflect that, your culture will definitely suffer. And you see both bad behavior and collateral damages across the culture and the organization as a whole.
Yeah. John, you've had so many years in experience in risk management and seen so many cases, right? Both in your private practice and on just public information that come out. What kind of risks do you see attached to this incentive or very aggressive incentive for performance? Do you have cases you could share with us?
I mean, I have I have cases that I've personally been involved in over the years with a large organization that I worked for. I was an audit director, and these occurred at the business unit level, where people were aggressively reporting revenue in order to make their goals or going light on their reserves. You know, inventory obsolescence reserves can get very complicated. Accounting reserves around customer accounts receivable, warranty reserves, like these judgmental areas can get murky. You know, in terms of like the big ones that have happened, the one that comes to mind, there's a couple actually that come to mind. One is Wells Fargo Bank. You know, one of the largest banks in the United States, going back now 10 years ago when this all came to light, but they put in a program. It started actually in 2002, and then it came to light in 2016, where at the retail banking level, the branch banking level, and they had probably thousands of branches, had placed programs in place to create more customer engagement. There was a mantra in Wells Fargo that really came from the top, which was 8 is great. And what they were trying to do was to have 8 products being used per household. So accounts, savings accounts, money market accounts, electronic banking, different services, credit cards. And so what happened over time was that the pressure on these branch representatives to create false accounts without their customers' knowledge. And I think what I had read was something like 3.5 million accounts were impacted. Customers were impacted by this, where the branch people were creating false email addresses. They were moving money among new accounts, from old accounts to new accounts, to show that there was activity, all without the customer's knowledge and obviously their approval to do so. And what resulted was that the CEO lost his job. He had, I think, a $2.5 million civil penalty. He lost $40 million in variable compensation. And maybe if it doesn't get worse than that, he was banned from banking forever by the banking regulators in the United States. So, you know, the reputational issue, I don't know what it cost Wells Fargo to get out of that mess, but it was expensive. And all driven by these objectives of trying to increase customer engagement. But obviously, there were no guardrails, or the guardrails were removed. And so it became a mess. I mean, maybe a bit more recently was the Volkswagen and the emissions and the software. And the engineers were working against really an impossible target. So what did they do? They modified the software to corrupt the result, to show better emissions achievement. I think, if my memory serves me right, I think it cost Volkswagen, and again, beyond reputational damage, like $30 billion, $30 billion to get out of that. So programs were in place to achieve these targets, but obviously things went off the rails in a really bad way. And those are just two that come to mind.
Yeah, it's actually pretty common to see cases like this, right? Um, just addressing a question here in the chat. Alexander, we're going to get to your question by the end of our talk, okay? So I'm not going to skip so far, but this is one of the points we want to address by the end of this talk. John, moving into deeper into this talk, do you see risk management? Do you see cases in companies where risk management is embedded in the compensation or incentive design? And if you don't, if you don't know of cases or it's not common at all, why do you think that is so?
Another great question. I don't know if I have a direct answer to it, but what comes to mind is this, is that you've got sort of like three layers or three paths that are moving in the same direction, but there's not the integration of those paths. And that is that strategy is typically developed by the CEO and by division presidents. And then the compensation piece, and Paulo mentioned this earlier, was it's HR, but it's also the compensation committee of the board, right? If it's a large organization, it has a comp committee, and they set the compensation. And then you also have this risk function. It may be overseen by a chief risk officer or often by the CFO, and they're not working in some integrated fashion or in unison. So, like, the comp committee will say, did we achieve our targets? Therefore, are we going to pay out this variable compensation? And the risk officer may be asking, did we work beyond our risk tolerances in order to achieve these objectives? In other words, promoting some bad behavior or some measure, whether it's financial or operational, that's not quite true. And so I think the problem is that those three, call it functions, don't necessarily operate together as it relates to strategy, payment, the compensation program, and risk management. And so therefore, there's this, I would say, if they were working together, there might be this tension. If they're not working together, it's somewhat diffused.
Paulo, do you see, I'm imagining a typical MBO process or cascading process in an organization, right? We have the strategy, we have the main goals, EBITDA or cash flow or whatever goals they put in, and they cascade attributing, to each department or business units their part in the whole. And there's a process to this, right? And in the end, you have compensation, cards with KPIs and targets to them that will generate each manager's compensation. Is it too far off to imagine an extra step to this process where once you have the target, the KPI and the target for each manager, you question what kind of distortions could this target, especially if it's a very aggressive target, cause? And what risks should I be looking at if these distortions happen, Just one extra question after the MBO process is done,
Right. I think that would be incredibly valuable, if not just for the exercise of asking those questions, already extremely valuable for the organization to have a map of that risk. As a matter of fact, I haven't seen that happen very often, unfortunately. I think the maturity of organizations in terms of how they cascade that process is limited. So I've seen that process happen either extremely fast, within 3 weeks, they want to be done with the targets and set the targets, and therefore they end up with financial metrics that they already have in the budget from the previous year. or a very long cascading process that, to be honest, the organizations today do not have a component tied to risk yet. I do think it would make absolutely sense to add that as part of the cascading and planning process, and a continuous quarterly review of that definitely would benefit the organization. I haven't seen anyone do that successfully beyond level 5, I would say. I think that is one point. I've seen, as John mentioned, there's the compensation board is asking those tough questions, but usually they don't go beyond level 2, meaning CO, C-level, maybe VPs. I would like to see definitely companies do that exercise more thoroughly in the lower levels, because that's where a lot of that behavior happens, right? We have discussed a few of those, but for sure that would be extremely beneficial.
And I had a point there too, Guilherme.
Go
Just
ahead, John.
so when I was an audit director for a really large corporation years ago, they had 235,000 employees. I was there about 7 years, and it took me 5 years to really understand how the organization really worked. There were 18 business units. And what I would try to find out, and this was kind of closely guarded information, was you look at the strategy process. Well, I knew what the strategy was at the CEO level. There were certain metrics that we had in place. But when you had these incentive programs cascade down to the, call it the team level, or really the individual level, what I wanted to understand was, what is motivating these divisional managers or these center managers, site managers, and what are their motivators here in order for them to receive their compensation? And when I had a great understanding of what are they trying to achieve, I would look at risks associated with that. And I could tell stories about what specific things I'd be looking at. But what just the other thought that came to mind is I was tasked as an audit director with auditing the bonus programs. And they were like the worst 2 weeks of the year because people just instinctively just figured, I'll get my bonus. And, you know, and what Paulo had mentioned earlier in our conversation here is there's just that expectation that 99% of the time I'll get my bonus. But when I challenged the results with at least measurable data, there would be a lot of pushback by division CEOs, division presidents, where I was intimidated. I wish I could do it over again, but you get into a very, very sensitive area about this is my comp and I'm expecting to get it and you're not getting in my way. So, you know, life gets complicated. It's not just pure risk management, it's behavior and how you navigate people's behavior to exact the right result is tough.
Yeah. This is a very interesting comment. You said that you looked then at what risks could be emerging from the compensation model, right? But you did that within your risk silo, right? It wasn't part of the compensation, by my understanding of what you said, right? It wasn't part of the compensation process, right? It was like they do something here, you do something here, but didn't necessarily connect one to another, right? How could it connect? How, going into Alexander's question here, how could ideally this work so that you don't, you have risk return. We have a pressure to increase return. Naturally, risk is going to go up, right? So how do we connect these two worlds? Do you have an idea or a vision of how it could be?
Well, along the lines of what I was describing is from the CEO's viewpoint, the CFO, the CEO, the senior executive team of this multi-billion-dollar company, 18 divisions, is that they want They want the best result. And so the best result is an orchestra. And they're conducting the orchestra. And I'm simply the tuba player, right? But everyone has to play their note in that orchestration. And so therefore the incentives for the risk person, me, are going to be different than the incentives for that division president. But if I achieve my goals, my incentives, in the long term, and maybe it's not short-term focused, is that division will meet its goals as well. Maybe
Yeah.
not a
So
precise answer to your question, but it comes down to maybe the function and what's motivating the function for the greater good of the organization.
okay. So you touch on a point, long term versus short term, right? Which I think there's a mismatch when we talk about bonuses and risks. Risks usually aren't for the year, right? Risks are maybe it'll turn out 3 years from now, 5 years from now, but the bonus is for the year, right? How do we balance these return in the short term versus risk in the long term? Paulo, do you have any suggestions on those lines?
Again, excuse me. I don't think there is like a definitive perfect answer to fix this problem. But I do see. I have seen in practice three main mechanisms that have been employed with some level of success. I think one is what I like to call the canary in the coal mine. So setting KPIs or leading KPIs for risk. That requires the company to have clarity on what the risks are and have metrics to foresee potential risks, set KPIs on those leading indicators that we're setting risk, and track those. Right. That's I would say that can indicate bad behavior. I think the simple one that tends to work better when we're talking about the executive team is long-term deferrals and clawbacks. I think instead of paying out everything on a yearly basis, at least a part of the bonus is deferred over a 3 or maybe 5 year period. Coupling this with the clawback provision, I think also ensures that we have leaders who are committed with long-term results, not only in terms of risk. We talked a lot about almost criminal risk, but also in terms of, like I said earlier, selling the future for the present. That long-term deferrals tend to play a role there. And I think the last one, to be short, is have clearly defined golden rules or the non-negotiables, right? And those are specific triggers that the organization can set that if one of those are broken, then the bonus is zero, right? I see a lot that in safety. I remember when I was a young consultant, we had a company that had this in their scorecard, and one of the consultants was driving over 35 kilometers per hour, and the entire company mobilized around that. So that consultant should go down to 30 kilometers per hour, because that was one of their golden rules, safety golden rules. Do not, they cannot, absolutely non-negotiable, and it has a certain level of success, but again, it requires a lot of understanding of what the risks are and the known risks. I think it has limited impact on the unknowns, and for that, I'm hoping that John will have a better suggestion than the ones I have.
Well, maybe just to add to that, these hard measures or pay for performance measures that are hard, like revenue or earnings per share, right? Those can be, I'll call it managed in a bad way, is that, what they call risk-adjusted metrics. And I'm not deeply involved in setting risk-adjusted metrics, but, economic profit, the quality of earnings, customer engagement, like these things should be measured, and they should be measured with the appropriate balance of like making sure that behaviors are in place as well, or the right behaviors are in place. So I only draw the distinction between hard metrics and maybe these risk-adjusted metrics that are maybe a little softer, but equally valuable to the organization in achieving its strategies.
Okay. So getting a bit of what both of you said, getting the example from the driving at 35 kilometers an hour, I imagine within an industrial complex or something, right? That is not tolerated. And the behavior that you're mentioning, John, um, I actually saw one case where they created behavior. It's very hard to measure behavior, but you can measure control over your risks, right? So if you have mapped out risks and you have controls that are there to mitigate these risks, you can, like the 30 kilometers an hour issue, right? You can measure if these controls are actually being executed, right? And that be put as a condition for incentives, right? So yes, you will be paid if you meet your targets, your challenging targets and so on, you'll get your bonus, but there's a condition. The controls over these risks that are under your responsibility have to be in place. That could be like a condition for the incentive, right? So if the person's driving at 50 kilometers an hour in the industrial, within the industry, and he's caught once, twice, he could lose his bonus, you know, just as a simple example, right? Go
Very
ahead,
quick
John.
story. So that large organization I worked for ran a childcare operation. They had like 800 or 1,000 childcare centers around the United States. And I'm going back, but background checks were extremely important in terms of pedophiles being in daycare centers. And the new CEO of that business unit, the president of the business unit, said to me, I need a zero tolerance policy around the paperwork, and it was paperwork back then, of background checks. And if if you're a center director or a district manager and you have bad paperwork, you're out. And so it was amazing. Within 6 months, the paperwork got cleaned up. And we were able to measure that by going out and conducting reviews of centers all over the country. And so you set a target of zero tolerance for that, or the consequences are grave enough, you'll lose your job. People hop to. And there's a mix of strategy, reputation, risk, and control.
Yeah. We're running out of time, but I'd like to show a little bit in practice how these things can, be connected through a software platform, right? So let me share my screen for the last 4 minutes and try to show how strategy, performance, risk, and compensation can all be connected. Okay, you guys seeing my screen?
Yep.
I jumped in our software here. Just my intent is not to show the whole software, the strategy management or performance and so on. It's just to see this line of connection between these three topics, right? So I'm going to start here with strategy. I have a strategy map. I have a objective here that is not being met, right? So I can click on it and cascade this objective throughout the organization. So I have EBITDA, I have projects, OKRs, all connected to this objective. And connected to EBITDA, I can cascade through the business units, through the departments of the organization, each department's responsibility. So OpEx, cost, revenue. And here I already connect risks to the objective, right? So that exercise that you mentioned, John, that you did as the lead auditor, of looking at the incentive programs and understanding what risks could be generated from there, you could connect that in a single platform and not leave it separated into, silos. So here we're seeing a risk, customer default, another risk, cash deficit, connected to this KPI, EBITDA. And this could be done at any level, all the way down to the operational level. But while they are monitoring performance, they are also keeping an eye on the risks that are inherent to trying to achieve that target, right? So I'm not going to go into details here of how to do risk management or performance management, but this comes together in the compensation model, right? So I'm going to look here at my scorecard, which generates my compensation. So my score is not that good, 59. This is just an example, right? I can see why. So I have the KPIs, my targets for each KPI month by month, right? And accumulated, and how this number is being built through my KPIs and the weight of each KPI to my performance. But the point is, I can have a trigger, right? I can have a trigger that tells me if I'm eligible for this compensation or not. And this trigger could be the risks which I'm responsible for, which my business unit, which were mapped in my business unit or my department. So here, in this example, I didn't put a trigger, but I could have a sign here saying if this trigger is met or not. If I'm not doing control over my risks, which is integrated in this same platform, I could have a red sign here on the trigger saying that, okay, I do have some bonus expected, but if this is red, it's not going to happen, right? So I put a condition for the bonus, which we talked about earlier, right? I just wanted to go really quick here, just to show in practice these topics that we talked about goal cascading, about creating a bonus. Oh, and there's also a survey here, guys. Does your company have a system that connects incentive, strategy, and risk? I believe most people won't, right? And most people don't. Most people do not have a formal connection between these three points, right? I thank everybody that was here with us today, especially you two, Paulo and John. It was a really rich conversation. Whoever wants the attendance certificate, you can fill in the Google Docs here for us to get your information and put it in the certificate, and we'll send it out today. Guys, I wish I had more time to explore this topic with you two. It's a very interesting topic, and that so many companies have hard time, putting it all together into a management model, right? Great insights. Thank you too again, and thank you all for participating.
I enjoyed it, Guilherme. Thank you. Thanks, Paulo.
Been a pleasure. Thank you both.
All right. See you guys.
Bye-bye. All right. Take care.